been a very sharp increase in both tax and non-tax revenue collections of the government. And it is not just the case that these collections are high on a year-on-year basis from the pandemic hit numbers of 2021. They are actually very significantly above what they were pre-pandemic as well. So this is real, genuine boost to revenue collections of the government, which is great because this allows support for another leg of the government strategy, which is support for capital expenditure. And you can see that capital expenditure is now a level above where it used to be pre-pandemic. I mean, this was something that was ramped up very sharply through the second half of the last financial year as part of the demand push, but has, as you can see, been quite strong ever since. And so this is a very important part of the government strategy to both support demand on one side, but also create supply-side assets for the future. Now, where does that leave various deficits? Well, as you can see, the numbers available for April to November, obviously the estimates for the full year you will get tomorrow morning, but the publicly available numbers for April to November clearly show that the fiscal deficit is not only below what it was for last year for the same period, but also below what it was in the pre-pandemic phase in nominal rupee terms. This is also true, by the way, of the primary deficit, which is very substantial. It's half of what it was in the pre-pandemic period in rupee crore terms. So this is a very substantial correction. And of course, if you think of it in terms of percentage budget estimate, you can see that traditionally, because a lot of the revenue in India tends to be front-loaded, the fiscal deficit of the first half or the first in this case, April to November period, tends to be above the overall full year, and then in the course of the next few months, it comes down. But you can see that April to November 2021 has been particularly good, with numbers coming in at just 46% of the full year number. So this is a particularly good performance. Now moving on to the financial sector. Obviously, this is always an area of macroeconomic risk and stability that we need to look at. There were many commentators who had expressed the fear during the last 2 years that the financial system would become very stressed as a result of this shock, this pandemic-related shock. And you can see, however, that this sector actually has weathered it rather well. Whether it's the gross NPA level or the net NPA level, both of them have continued to steadily decline through the last couple of years. And this is even true after the initial IBC moratorium was removed. So this has not gone through a spike after that. And the banks continue to increase their capital adequacy ratios. So they are becoming much more better capitalized. This is important, that even if there's some later lagged impact of the pandemic on the economy, the banks are well capitalized, and they seem to have taken the pandemic shock in their stride. Now, of course, the financial sector is not just about stability, it's also about growth. And the last couple of years did see credit slow down significantly. But in the very latest numbers, you can see that it has begun to